For the second straight day, U.S. stocks had a robust bounce to the upside. Much of that positive sentiment was a result of conciliatory tones between the United States and China regarding the ongoing trade war. What does that mean for our postures going forward? Well, we did have a change with the S&P 500 and the Dow Jones. Both of those went to bullish posture, but the NASDAQ and the Russell 2000 still have a bearish posture, and we still have downtrending moving averages. So we'll take a look at all of that. We'll then take a look at a trade application example to try to take advantage of the last couple of days' higher prices by doing a bear call spread at more favorable levels. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's August 29th, 2019. First of all, if you're new, welcome aboard. Remember, go to YouTube, click subscribe, and while you're over there, check out our description area where you can sign up for our email distribution list. In fact, you'll find that link for the hyperlink embedded in the logo in front of you as well. But if you sign up for that link and that list, we'll send you all the stocks that are giving you overbought and oversold cluster signals in the S&P 500 on a daily basis. Sometimes that's effective, sometimes it's not. A couple of days ago when I did this video, we had probably about 100 different stocks in the S&P 500 that were giving us oversold cluster signals. And you can imagine those were the types of stocks that have bounced strongly in the last couple of days. So make sure you're taking full advantage of that resource. In addition to YouTube, we also have a big presence on Twitter. My handle is @BrandonVanZee. I would encourage you to follow me there. Also, thank you to everybody who clicks like and retweet on these Market Outlook related posts. We really appreciate it. Lastly, we have a presence on Facebook as well. Be sure to join us in the group embedded in the logo in front of you. All right, let's go ahead and dive into the charts. As you can see, I've got chart 4B pulled up here in front of us. This will give us a good view of the 4 different major U.S. equity indices. And as I stated in the intro, we had a nice big up day for the markets. All of the markets were up over 1%. The range was anywhere from 1.27% as our lowest gainer on the S&P 500, all the way up to 1.63% on the Russell 2000. Now, speaking of the Russell 2000, let me right-click and maximize that cell. You'll recall that 2 days ago when I was with you on this Market Outlook presentation, I identified that oversold cluster signal showing you that green dot right there and that green dot down below. That gives us a little bit of a heads up that we might be due for a little bit of a bounce here, at least in the short term. Remember, that doesn't have to mean that the trend is going to change. Right now, we still have a path of least resistance to the downside, but we had gotten a little bit overdone in the selling on the Russell 2000. And of course, the last 2 days have been just monumental candles right there. So anybody who would have been brave enough to buy at the end of that day or the beginning of the next day had a nice 1-2 punch here on Wednesday and Thursday. Now, as you can see, we remain with a bearish posture despite the move higher, and we still have clearly a set of lower highs and lower lows that we're dealing with. That's really my concern about the market right now. It's great to see the bounces that we've had the last couple of days, but as you look at all 4 of our charts here, notice that all of them have that red moving average, and look at where we stopped on most of these charts. There's the NASDAQ, there's the S&P 500, and there's the Dow Jones. All of them are sitting right under the falling moving average. And sometimes that moving average can be used as a resistance area. Coincidentally, where we find ourselves with most of these, let's just use the Dow as an example. So let me right click here. Notice that we are basically sitting not only at what would be deemed a kind of a diagonal resistance with that 30-day moving average itself, but we also have a horizontal resistance that we're sitting at. You know, if we were to get our drawing tools out here and just kind of draw a price level, you can see basically right there is a fairly strong level of selling that has taken place, you know, on several of these candles along the way. And that's effectively where we find ourselves right now. And that pretty much sums up the story for most of these charts. And that's why I remain a little bit skeptical right here. Again, it's great to see you know, some resilience out of traders and investors, but we've seen how fleeting that has been in recent weeks. It seems like every time we get up to approximately this level here on the S&P 500 around 29, 25, the sellers take over and push us right back on down to about 28, 38, somewhere in that general vicinity. So right now we're kind of in this sideways channel, slop and chop, where we haven't broken out to the upside and we haven't broken down to the downside. And so we kind of are waiting and seeing at this particular juncture. Now, one thing I did want to point out as well is that the market sentiment lines, remember, those are your orange dotted lines that you see here. I know they're a little bit difficult to see on this particular chart view, but if you maximize the cell, you can see it a little bit better here. There's our dotted orange line right there. It is falling, so that market sentiment line is falling across the board, whether you're looking at the S&P 500, the Dow Jones, NASDAQ Composite, or Russell 2000. So from a longer term perspective, we still have work to do, despite what all of a sudden we've got a bullish posture here on the Dow Jones and a bullish posture on the S&P 500 and the intermediate term. Remember, each one of these 4 different colored lines tells a different story. If you kind of want to think about it from a broad perspective, you can think of the red line as the day traders, the blue line as the swing traders, the green line as the trend traders, and the orange line as kind of your longer term investors. And so, we do have opposing postures in some cases, but right now from just a purely price action perspective, I remain a little bit skeptical until I can see us clear that moving average and then establish kind of a new range of support at a level hopefully above that moving average going forward. So only time will tell if that happens. Of course, we'll do our best to keep you abreast of any ongoing situation. Remember, David will be with you tomorrow. But then we'll have a holiday weekend, and I'll actually be off an additional day on Tuesday, so there's no Market Outlook video on Tuesday, but we'll be back in the saddle again, of course, on Wednesday's video as well. All right, let's go ahead and take a look at our next chart setup, and this one will be our 3 green arrows chart setup. As you can see, right now, it's a mix. In other words, none of the charts have 3 green arrows, none of the charts have 3 red arrows. Right now, we've got a mix of green and red arrows across the board. So let's kind of tally them up a little bit here. The S&P 500 and the Dow Jones are getting awfully close to 3 green arrows. Why I say that is you'll notice we have a green arrow on the stochastics, on the MACD, and we're just waiting, in this case up here with the Dow Jones, to get above that moving average. Same thing can be said over here with the S&P 500, green arrow number 1, green arrow number 2, waiting for that one up there as it crosses up and through the moving average. The other 2 charts, we've got a little bit more work to do. Notice that the NASDAQ still has a red arrow on the stochastics, as does the Russell 2000 here. So anyway, not that I needed to tell you this if you've been paying attention in the month of August, but we don't have an established trend going right now. Probably a slight tilt negatively if you had to force yourself to say we were in a trend. But I think if most of you were to look at the price action here over the last 3 weeks, honestly, most of you would answer that we have basically a sideways market. It feels a bit more violent because some of those days have been, plus 1%, down 2%. It's a little bit more exaggerated movements. But if you look back over the last 3 weeks, we've accomplished pretty much absolutely nothing. We've just gone sideways, and that's about it. So anyway, some of you might feel like you're getting chopped up in this market. If that's your feeling, then you're probably not too far off because we have had some bigger moves up and down more recently. But right now, we're waiting for further information in regards to 3 green arrows. On the 1040 crossover method now, this is chart 4D. Right now, the only chart that we have a bearish crossover on is the Russell 2000. Remember, this is a 3-year weekly candle chart we're looking at now. And the Russell 2000, as you can see, does have that orange line crossing down below the blue line. So that means our 10-week moving average is down below the 40-week moving average. You can also see the clear break there in terms of the MACD2 line. The black line is coming down through that pink horizontal line there. Whereas we're not seeing that type of behavior on any of the other 3 charts. So on the whole, I guess you could say 3 out of the 4 charts are holding up reasonably well from a longer term perspective. One of them is a little bit more challenged, but even with this one, as I've been mentioning in recent weeks, we don't necessarily want to count the Russell 2000 out yet. We don't have major support breaks that are taking place here. It did look like earlier this week it wanted to potentially break down through some support levels, but with the rally the last couple of days, we're right back kind of in that sideways channel. So if I were to right click and maximize this, you can kind of see what I'm looking at right here. We were trading at approximately these levels that we're at right now back here at the end of May. And so would it be entirely surprising to see us rally right back on up here to I don't know, just a hair under 1600? Not so much. No, it wouldn't surprise me in a big way. And if that happened, remember, you should expect that the posture will flip back to bullish as well. Now you can see the problem with this posture, and it's oftentimes a problem with most technical indicators. It uses information from the past to try to project information about the future. Now, when you have a trend like we did over here, using information about the past is not necessarily the end of the world when trying to project information about the future. When you have less of a trend, in other words, directionalist markets like we have had here more recently, then you have the tendency for more whipsaws where, geez, you're getting in at the wrong time and you're getting out at the wrong time. So, no indicator is going to be perfect, but you do have to kind of be mindful of that and watch out for those indicators when we are in these choppier markets like we find ourselves in right now. I would also point out that notice that we're getting these green arrows to show up under this week's candle for those 3 out of the 4 that I mentioned before. And what those little green arrows signify in this chart's case is that price is back up above the 10-week moving average, right? Now, just like I said, don't get overly pessimistic over here on the Russell 2000. The reverse is true as well. Don't get overly optimistic on all these charts that are showing price action above it, because we've seen how quickly those can also go away. We've had a few of those flip-flops here in recent months. So, but for those of you that are looking for a reason to kind of guess that the stock market is starting to stabilize a bit more, that does help, because if we ever do go on a monumental run, like we saw here a couple of years ago, many of that run is going to be established by seeing some of these green arrows pop up along the way. So it doesn't mean that this most recent green arrow is going to lead to a massive move higher, but if a massive move higher is on the horizon, it has to start with one of those green arrows. All right, let's go ahead and take a look at our next chart setup now, which is our intermarket analysis 12 grid. Now remember, on these particular charts, the background color will tell us whether we have a bullish or a bearish posture using the market forecast intermediate term line. That's the green line on the market forecast. So as we look at this first set of 12 grids, you'll see 4 pink charts on the board with those bearish postures. Now, somewhat surprisingly, at least to me, is that preferred stocks have a pink background. You can see that the intermediate line did fall out of the upper reversal zone, so it must have fallen from 80 down to 79.11 here. But as I look at this chart, I don't think I would necessarily get aggressively bearish here. That's still a nice looking chart there for preferred stocks. The other ones I can definitely see. The Treasury yields, they're getting knocked around. Today was a rare up day for Treasury yields. They were up 3.41%. We ended the day at 1.51 on the 10-year Treasury yield. But that's an ugly looking chart. This one over here, the Master Limited Partnerships, that's also an ugly looking chart, and so are the ag commodities down below. So those ones don't surprise me quite as much. Again, the surprise from my perspective is the preferred stocks. Now on the bullish side of the equation, some of those charts look better than others as well. The dollar has been extremely robust here recently. In fact, that's something that we discussed a little bit in my question and answer session here today. So for those of you that are premium members, I invite you to go and watch the recording of that, as we had a lot of good chats here today, a lot of different discussions, whether we're talking about dividend stocks or swing trades. We even had some conversation about the housing market and some technical indicators. So anyway, feel free to check that out when you get a chance. That was about 2.5 hours long, so lots of great content for those of you that are premium members there. But we were talking about some of the things that were going on around the globe, and some of the things that is being influenced by the U.S. dollar. And as you can see, the U.S. dollar continues to go higher and higher and higher. One of the things we discussed was high-end real estate, and how a lot of outside investors that traditionally were buyers of high-end real estate in the United States are maybe balking a little bit more because where they reside, they have a weak currency versus what we've established here in the United States, and they're just not able to buy as much as they once would have been able to in terms of houses and other real estate here in the United States. So that certainly has some reverberations through lots of different markets, whether it's stocks or otherwise. But dollar had a great day. We're up here sitting close to 3-month highs, and if I had to guess, we're probably going to break out to the upside. As you can see, we established this nice little kind of, almost like a bull flag right there, and we closed near the high of the session. So just a little bit of a move higher, and we'll get up and through this candle from August 1st right there. But clearly, path of least resistance with that moving average is still to the upside. Same thing can be said for gold. Now, gold did have a pullback day today. Seemed like this was a day that kind of reversed some of those trends that we've been seeing for much of August. In other words, some of those areas like your utilities and your Reits and gold and bonds, etc., they struggled on a relative basis today compared to some of the more risk-on types of mindsets out there. Whether that is going to change the trend or not is another conversation. Right now, you should probably assume that the trends will hold because that's what they have been doing for much of the recent history. In fact, you look at the gold chart right there, and every time somebody wanted to doubt it, gold just ripped higher yet again. Same thing goes for long-term treasuries here and even foreign bonds. So REITs were up today, but they weren't up as much as the rest of the market. The REITs were up about 0.78% today. Remember, most of the general broad market indices were up over 1%. So while it looks nice on the chart, it's actually a relative underperformer on a one-day basis there. Oil was up a little bit here today. We're using USO as the ticker symbol for our proxy here. It was up about 1% today, but it's got a lot of work to do. As you can see, it doesn't look quite as strong as gold does. Let's go ahead and take a look at our next chart setup. This one will be our foreign stock markets, chart 4F. All right, so as we look at this, it's a little bit more, it's a little bit better looking than it was on Tuesday. On Tuesday, it was pretty ugly across the board. Here we're starting to see, some signs of life here and there. I did talk about that oversold cluster signal on Brazil 2 days ago. You can see we've had 2 straight up sessions there on EWZ, so that would have been a nice speculative trade to take right there. Some of the other areas that have rallied pretty strongly, I would point out Canada. I mean, Canada had a really nice 1-2 punch there in the last couple of days. We're now sitting up there just a hair above that moving average. So if it can maintain these levels, that moving average will likely change green as soon as tomorrow. And some of these other areas are starting to establish some decent bottoms as well. The United Kingdom kind of looks like it's putting in a bit of a inverted head and shoulders pattern down there with lots of clusters. So perhaps we're due for a little bit of a rebound in the UK there as well. All right, let's go ahead and take a look now at the United States. This is chart 4G. And as we pull this up, things look better here as well. Remember on Tuesday when I was with you, it was only the 3 bottom ones here. It was the staples, utilities, and real estate that had the green charts. Today, we can add a whole bunch more to that conversation, including the S&P 500 itself, along with communications, discretionary, industrials, and healthcare. Now, of those, I would say it's the discretionary ones that are maybe the ones that are most interesting. Notice that the candle on discretionary right there, let me kind of right-click and zoom in so you can see this a little bit better. This was a pretty aggressive up move for this candle. We were up 1.5%, so XLY was up more than SPY and therefore a relative outperformer today. But in doing so, not only did we cross up and over the moving average, but we also cleared this prior high candle right here. So that's something that you'll want to keep an eye on right there on August 22nd. So that's a promising sign because now all of a sudden you could make the claim that we have a set of higher highs and higher lows. Right over here when we bottomed out on this candle, technically that was a little lower than this candle and therefore that was still in that pathway of lower lows. But after establishing this bottom with this kind of hammer looking candle right here, we went up, this candle cleared this prior high, we pulled back a little bit forming this new low. Now we've rallied strongly enough for this candle to be above this one. So we have a higher high and we have a higher low. That is the sign of a infant uptrend, which is is promising to a degree. Now, part of that might have been one of the stocks that we actually own in my top-down trend trading class. Many of you attend that class, either here at Market Scholars, or some of you might have attended that class when I taught a very similar one when I was with Invest Tools. But anyway, Dollar General is a stock that we had purchased quite some time ago, it really didn't do anything for the longest time, and then all of a sudden today it rallied strongly. It was one of the best performing stocks on the entire S&P 500 today, up just over 10% there, and clearing this entire kind of sideways price pattern that we had been stuck in for much of the last 3 months. So keep your eye on Dollar General. That's a nice breakout move that we saw right there. But in general, yeah, it's kind of the XLY that is maybe the one that is starting to make some legitimate movement there for us. The other ones that turned green along the way are still struggling with kind of the same concept as the S&P 500, which is we're still kind of either stuck at or just a hair below the moving averages. And so they're not quite as easy to trust in those particular cases there. The other charts that are still bearish include financials, technology, materials, and energy. Now, real quick over here on the internet, I do appreciate those of you that went out of your way to click the word like or the heart icon, however you do it on your side. There's various ways to kind of make your case there, so to speak. But I appreciate all of you that came out of the woodwork to do that. I mentioned on Tuesday that on the prior version we had 100, and I'd really like to see that up and over 100 if we can get it. You guys, you basically had the opportunity to do that, and you signed up for it. So thank you for all 118 of you that did that. Remember, it's nice and easy to do it by just watching it on our website and just clicking it right down below here. If you want us to do these videos often, make sure you click that like often as well. It gives David and I a heads up that you're enjoying them, you're getting value out of them, and you're doing yourself a favor as well, because in the Twitter algorithms, it's basically recognizing that if you're engaging with either David or myself, or ideally both of us, that you want to see our content in the future as well, and that way you don't miss anything important from us. Now remember, as I mentioned before, my question and answer session is now posted. David taught his portfolio management class here today. That is now posted. He got into a country that I guess I would have never guessed he would have gotten into here today. It's just not a very often talked about country. So if that intrigues you as far as what country ETF he's buying for his portfolio management class, make sure you check out that particular recording. And then of course tomorrow he's got his technical analysis class Friday at 11 a.m. Eastern time before we head into the holiday weekend there. So take advantage of those resources as well. All right, let's get into our trade application example. I'm going to come over here to chart, how about 4A, keep it nice and easy here. And I'm just going to keep it pretty simple here today by looking at QQQ. So as I mentioned before, I'm not sure I'm to the point of trusting this market after just a 2-day rally. After all, every time we've trusted a 2-day rally in the past, it has been regretful. In other words, we had, kind of a 2-day rally right here, a robust move. We had a sell-off right there. We had another pretty robust 2-day rally right there. We had a sell-off day. So, we're back up into this range where I would expect sellers to kind of step into the market and push us back down to this support area where the buyers come in and support the market. So with the S&P 500, it actually has a bullish posture now, and that's why I'm using the Qs for this particular trade, because as you can see, we still have a bearish posture on the Qs. And so what I want to do here on the NASDAQ 100 is sell a bear call spread. That would allow me to take advantage of the bounce in prices here recently and allow me to get a break-even price much higher up in this vicinity here than I would have been able to had I made that same exact decision just a couple of days ago when prices were much lower. So over here on the trade tab, I do have that trade already established. This is the September monthly contracts here. These ones are only good for the next 22 days. So this is a smaller amount of time than we normally deal with. Notice that the credit is 46 cents. I'd actually need to get that to 47 cents in order to have a 30% return on risk. But remember, sometimes you might be willing to accept a slightly smaller return on risk than 30% if you're going to be holding the trade for less than 30 days. In this case, we're only going to be holding it for 22 days. So I'm comfortable with this. However, I will also point out for those of you that are comfortable with the idea of doing a $1 wide bear call spread as opposed to a $2 wide like I've got established here, you could really just change the 196 calls to the 195s Here you would get a credit of 26 cents, and that would be more than a 30% return on risk on a percentage basis. The downside of doing a $1 wide right there is that you'd probably have to do more strikes to make it count or move the needle for you. So, for our purposes here tonight, I'm going to do a $2 wide. I'm going to accept one less penny than I normally would, and I'm comfortable with that idea because I'm going to be in this trade a lot less time than I normally would as well. Now, you'll notice if you click on confirm and send here, it'll give you your break-even price on this trade. And again, what I'm doing is I'm selling the 194 call on QQQ for the month of September, and I'm buying the 196 call for QQQ for the month of September. What that is creating is what's known as a credit spread, where I receive money up front for the trade, and as long as this particular ETF does not close above 194.46 on expiration day in 22 days, then I should have a pretty good chance of making money on this trade. So to kind of put that, tie a bow on that, so to speak, let's take a look at 194.46 on the chart and just see kind of where that range is. So it would be somewhere in this general vicinity. I can't get my mouse exactly on it, but it's right up in that general area where I'm pointing my mouse. So if you can kind of look at the gray crosshairs there, you'll notice towards the left, that is basically where the seller stepped in and sold this market off here at the end of July. And so if this stock market can stay below that level for the next 22 days, then this trade stands a decent chance of making some money. So let me go ahead and click confirm and send that one in, and we'll see if we can get filled first thing in the morning. All right, well, thank you once again for joining me here tonight. Some headway in the market today as we can finally say that the S&P 500 and the Dow Jones at least have a bullish posture. However, we still have work to do. The Russell 2000 and the NASDAQ Composite are still bearish, and all four of those charts still have downtrending moving averages that are likely going to be acting as a resistance area here, could be as soon as tomorrow. So we're going to wait and see whether that takes place or not. Whether or not it does, David will make sure he gets that information to you as soon as tomorrow in that video. So with that, I want to wish you all the best of success. Have a great Labor Day weekend. Again, I'll be gone on Tuesday, so the next time I'll see you is a week from today. So with that, have a great night. Take care, everybody. Bye-bye.